Advanced Financial Accounting. In this presentation, we're going to work a consolidation problem where we have two separate companies that we're going to be consolidating together as if one with the use of a consolidation worksheet. We're going to have company P, company S. We're going to say P is the parent, S is the subsidiary. The parent owns 100% of S, so that's going to simplify things a little bit because we don't have that non-controlling interest. However, what we do have this time is we're going to be dealing with goodwill, so there will be goodwill that will be involved, and there will also be some accounts or an account, the property, plant, and equipment, which will have a different fair value at the point in time of purchase than the book value. And these are going to be some of the new items that we have here. Now, we're going to start off with this with the consolidation taking place right after the point in time that the purchase happened, basically at year zero, we're going to say. So we're going to say it's kind of like January 1st consolidation, or the purchase happened. We're going to do the consolidation right after, therefore only dealing with, in essence, balance sheet accounts, no income statement accounts, no activity has happened since that point. Get ready to account with Advanced Financial Accounting. Here we have our information on the left, which is P purchased 100% of S outstanding common stock. So 100% purchase, P the parent, S the subsidiary. That happened on January 1st. So we're going to say at the beginning of the year. No activities has happened since that point. So we're going to do the consolidation at the same point in time. Purchase price, $304,000. And then we're going to say the different thing here that we haven't seen in prior presentations with regards to consolidations. Building and machinery, and we're going to say has a fair value of the $193. So in other words, if we looked at the information for P and S, this is the information for the two separate companies that we are, of course, going to be consolidating together with the consolidation worksheet. If I was to say, okay, let's take a look at the the book value of the machinery, it's the 248,000 minus the 65,000, and that's going to be giving us the 183. And we, of course, are saying that it's worth now 193. So the fair value is now different. That's something that we haven't seen in prior problems. So minus the 193, which is, of course, 10,000. So the fair value is going to be 10,000 higher than the book value. Just remember, when you do that, of course, you have to be considering the book value, which will be the value of the PP&E minus the accumulated depreciation. Also note that in practice, these would represent multiple accounts. We'd have to actually look at the depreciation schedules and value each piece of equipment in practice to really determine that. But in general, the account as a whole then is going to be higher by the 10,000 fair value. Okay, so other assets and liability book value, same as the market value. So we're saying as we go through this, at the point of time that the purchase took place, P is purchasing the stock of S, but we have to do this consolidation process. There's two companies kind of involved here. So what we're trying to do is value what the value is at the point in time that basically the control took place, the purchase took place at this point. So if we go through the line items as if kind of a purchase happened and we revalued S here, then that's going to be our objective. And what did we revalue? We left everything the same, but revalued the book value of the building and machinery, all other assets, liabilities. We are saying book value is equal to the fair value. So then P is going to be using the equity method. So the investment here is going to be on the equity method. This only represents the purchase price at this point, which is the 304, because no activity has happened. There's been no income. There's been no dividends since the point of purchase. And then we have the consolidation worksheet for 2000X5, same as consolidations worksheets we've seen before. We're saying, hey, give us P's books, give us S's books at this point in time, which is the beginning of the year, not the end of the year. Therefore, no income statement accounts down below, no activity since the point of time of the consolidation. Okay, so then let's pull out our little worksheet down below and say, all right, well, if I compare the fair value, if I think about the fair value, it's going to be the 248, or in other words, if I'm trying to figure out if there's goodwill involved here, I'm going to say, all right, let's pull out the trusty calculator. And if I was to take P's numbers, and how it's going to say assets minus liabilities, or just pick up the equity section, so we can do that either way, 34000, that's too many zeros, plus 54000, plus 109000, plus 248000, minus 65000, minus 14000, minus 128000. That's going to give us the 248, right? That's the book value, assets minus liabilities on a book basis. Then we just said that the machinery and equipment was higher by 10,000, right? So then we would add to that plus the 10,000. So that's going to be the 248. So if we were to revalue everything, we're saying, hey, assets minus liabilities is 248. Or in other words, you can obviously take the equity section, which is that 94,000 plus the 144,000, because assets minus liabilities equals the equity here. So let's do that one more time because something went wrong. 144,000 plus the 94,000. That's going to be the 238 plus the 10,000. That's going to be the 248. So that's going to be our fair value, not the book value, because we revalued here. And then we have the interest purchased by P was 100%. So then you would think that they would have the 248. But the purchase that they paid for this 100% interest was 304. That's the amount of the payment that was there. Therefore, we have that 56,000 of goodwill. Again, you might say this. Now, look, they paid stock. It's not like they purchased basically the net assets, but we're still doing this kind of negotiation process and trying to revalue things basically in a similar fashion so we can do our consolidation worksheet. And you'll see how the consolidation worksheet happens in a second. So we still did that process where we said, hey, we took S's information here, we revalued it to the fair value, we adjusted the accounts for the fair value, of which there was only the machinery and equipment. How is it possible then, if we did that properly, that P paid more for the 100% interest than assets minus liabilities or the fair value of S here? How can that be? Why would that happen? Well, it doesn't necessarily mean that we didn't fair value these correctly. We could have fair valued these correctly and still they paid more. Why? Because there's something here that's not on the balance sheet. There's something that's present, not on the balance sheet, and intangible. We call that intangible goodwill, something like a brand name, something that causes earning potential in the future above and beyond the simple net assets of the organization. And that goodwill then, we're going to say is going to be this 56,000. So then if we were to add this across, so P plus S, just like we've seen before, we just do our adding across. We're going to get to these total numbers over here, and that's going to be our starting point that we can now think about doing the elimination entries or the consolidation entries. That's what we'll do now. So similar process with the consolidation entries. We know that we have this investment account here. That's got to be removed. We know we basically have to remove the equity section down here. Now, I would usually think about this as one long journal entry, but it could be useful to kind of break this things out into component journal entries as well. So we'll probably do a little bit of both on some different problems that we look at. So let's consider this. I'm going to say, okay, first we've got the investment in S. Now notice I didn't take the investment off for the full amount. This 238,000 doesn't match the 304, which we know we need to be removing in total. But I'm going to think about this as a plug. So for right now, I would just say, hey, look, I know I'm going to debit the investment account. I don't really know what that number is, even though I put it there. Let's imagine we don't know what that number is. So let's just say, hey, I know that needs to be a credit of 304, but let's just keep it as our plug now. I know that these accounts down below need to be removed, the common stock for S and the retained earnings. I'm going to remove those. That's our normal kind of process for this consolidation. So I'm going to say then that we have the common stock for the 94. We're going to remove that. This is a credit, therefore we're going to debit it. And that'll have the 281 plus the 94. That's the 375 minus the 94 brings us back to P's portion, the 281, therefore removing S's portion. Same thing for the retained earnings. It's a credit down there, therefore we're going to do the opposite thing too, debiting it. So then we're going to post that out. So we had the 393 plus the 144. That's the 537. Then we're going to remove S's portion, the 144, bringing us back to P's at the 393. So there is that. So now if I was to take this 994 and the 144, normally if we looked at the conditions we saw in prior presentations where it was that we had the purchase take place for basically the book value, the equity as of the point in time of purchase, the assets minus the liabilities, or the equity at that point in time of purchase, and there was no basically revaluation, then these things would match out, right? These things would match out. But now we have that change. And so that's why we're going to do this in a couple different steps. So now we got the 94,000 plus the 144. that gives us the 238,000. So I would kind of think about us kind of backing into that 238,000 as the plug, the 238,000 not being enough to fully wipe out the investment as we want, but these two accounts did what we would expect. Now we're left with this 66,000 that we need to remove. We know we need to remove it up top. What's going to be the components that we remove that in our consolidation worksheet? Well, we know that we have the goodwill that we're going to have to be dealing with, and we know that we have the machine, the building, which we're actually going to revalue basically at the point of consolidation to the fair value. So let's think about that. We're going to say, all right, this investment needs to go down. So now let's make another journal entry. I need to remove the rest of that 66,000. What's the other side of that? So that makes it go down to 0. That's going to be the goodwill, which we saw on the prior slide with the calculation. We calculated goodwill to be the 56,000. So 56,000 of goodwill, that doesn't quite get us there. And the difference, of course, is the building and machinery. So we put the goodwill on the books, and then we've got the building and the machinery, which you'll recall we said on a fair value basis was 10,000 higher. And so that, of course, is the other difference. We're actually going to record that for our consolidation, representing the increase in the building and equipment at the point of time that the purchase took place. All right, so that's going to be those are the main components. So that means that we have now removed the investment. We've revalued what needs to be revalued at the point in time of purchase. We put in place the goodwill, and we dealt with the equity section. Now we have our standard kind of journal entry here also that would be taking the building here and the accumulated depreciation and kind of netting them together at the point in time that the purchase took place. So instead of representing the 248 minus the 65,000, we're going to kind of net them together as if they were, purchased basically as of the point in time of consolidation. So that's going to be our journal entry that we have seen before in prior presentations. Same process. We're going to be debiting the accumulated depreciation. That'll get rid of this. So we have the 161 plus the 65. That's the 226 minus the 65 gets us back to that 161. The other side then going into the building and equipment, basically decreasing the building and the equipment for the amount of the accumulated depreciation for S at the point in time of purchase. So there's the 402 plus the 248. That gives us the 650 minus the 55,000 now. And the reason we have note that we have two items that are hitting this account now. So this 55,000 is being representative of this building and equipment account here, and this building and equipment down here, netting out to that 55. So that's going to be our bottom line here. So if we just kind of review these items, the investment account here has been adjusted. So we took that down. We took that down by two journal entries, right? We had the investment account here, taking it down. So we have this investment account, and then we have this investment account basically netting out there. Then we have the building that we just took a look at. We have the accumulated depreciation, which we adjusted. The goodwill is now going on the books at the 56,000, and then we removed the common stock and the retained earnings basically for S. Now, I highly recommend working out some of these problems in Excel as well, because actually posting these things out, putting the physical kind of kinesthetic posting things out is as close to kind of the paper calculations as you can get without, having to write all this stuff out in a very tedious type of way. So I highly recommend going to those practice problems.